Hi everyone. I'm going to take a moment now and walk through a weighted average cost of capital demonstration problem that may help you out on one of the exam questions on the final. So, in front of you is a sample problem. The company has determined that its optimal capital structure consists of 30% debt and 70% equity. Given that information, we want to calculate the firm's weighted average cost of capital. And there's some additional information provided. K sub D is 6%, and K sub D represents the interest rate on debt. The tax rate for this company is 40%. The current price of the stock is $55. The growth of the stock is 0%, and the dividend in year 0 is $2. Now, to solve this problem, you need to have a couple formulas, and rather than having me type it, I've prepared it. I'm just going to copy it in. Typing and getting the formatting of the subscripts would be difficult. There we have the weighted average cost of capital formula. 2 lines below, I've dropped in the formula for the after-tax cost of debt, which is the first term in the weighted average cost of capital. And here, keep in mind I'm using K of D. The book may use R of D. The terms mean the same thing. The last formula we'll need is the required rate of return on the common equity. And here the required rate of return, the formula is we need to know the expected dividend in year 1 divided by the current selling price and add the expected growth. Okay, now to solve this, I'm going to do this in Excel. I think what we ought to do is calculate the debt first, which is the D term. Then we ought to calculate the preferred stock. We'll just call that PS. And then we ought to calculate the cost of capital for the common stock, or common equity, and we'll leave that as that. We need to drop in the weights. We know that this is 30%. Preferred stock, there's 0, there's no information provided, so we are going to assume that the capital structure has no preferred stock built into it, and 70% common stock. If we did that correct, sum would be 100%, which is good. I'm going to format these as underlined as we go. Now let's calculate the cost of capital for each of these components. Now, in the case of debt, we know that the formula we need to use is equal to 6% times 1 minus the tax rate, which is 40%. Okay, I'm going to highlight that and sort of show it up here in the formula bar. As you can see, it's the 6% interest rate on the debt times 1 minus the tax rate. Preferred stock, 0, it's not applicable. Now we need to calculate the cost of capital on the common stock, which we know is D1 divided by P sub 0 plus expected growth. I'm reading from this formula right here. Next, we need to calculate the cost of capital. Reading from the required return on common equity, we know that we have to figure out D sub 1 divided by P sub 0 plus expected growth. That's the dividend in the first expected year divided by the current selling price. Well, this is partly tricky, but with an expected growth rate of 0, it helps make the formula a little bit simple. Okay, we know that D sub 1 is equal to $2, and to calculate it, we have to multiply that times 1 plus the growth rate, which is 0. So I'm doing this the long way so we all understand that 2 times 1 plus 0 will still get us 2. With the equal sign, we'll come up with 2, which is 200%, and we put a percent around it. Next, we need to divide that by 55, and I'm going to put braces around that as well. And finally, we should add in the growth factor, which is 0, again having no effect. And now we've calculated the cost of capital on the common stock. We add a column to multiply the weights. Take C18 times D18, we can copy that down, and sum. One thing I noticed, I underlined the wrong cell. In our answer, I'll bold it here, is a weighted average cost of capital of 3.63%. I hope that's been helpful. I'll put this Excel program out in document sharing so you can review it. Thanks for watching, everyone.